This is Mitch, and welcome to the Real Estate Investor Summit podcast. I have Joel Block on the line, and we're going to be talking about syndications and starting your own fund. So this is all about raising money, probably accredited investors or the other sophisticated side. We're going to jump right in. How you doing today, Joel?
Hey, Mitch, thanks. Doing great.
So you're over in Los Angeles, right?
I am.
There's a little money floating around that city, isn't there?
Well, there's money floating in every city.
Right. That's what we learned. So tell us a little bit about your background and how you got to this point, the bullet points, and then I want to jump right into the syndication and raising a hedge fund or building your own fund and the differences, and maybe even compare it to what I do, which is just kind of one borrower, one lender, one piece of collateral. So.
Well, I started out in the CPA business as a youngster right out of college, but I quickly found out I wasn't much of a soldier. I didn't take direction very well. I really didn't, follow their lead and do what I was supposed to. But I worked on some really interesting accounts at Price Waterhouse. In fact, one year I counted ballots for the Academy Awards, which was kind of a fun thing. But the last account I worked on there was a giant real estate syndicator. And my job with an army of other guys was to convert the books and records of 500 partnerships into tax returns. And I just hated the work, but I loved the reading the partnership agreements. And I just knew that's what I wanted to do. I wanted to be a deal maker and go in that business. So that's what I did. I went in that business and started a syndication company. I ran that for a few years, fell into a venture capital transaction, and went out and raised $10 million for a venture deal, which I eventually sold to a Fortune 500 company. And I've just been doing deals ever since. That's it.
Wow. There's a 10 million ways to make money. My business partner, Raymond Braun, he's my business partner in the hard money loan business. At one point in my career, I had so much private money that I couldn't get it all out under the underwriting guidelines that I held for myself. And just because you have a lot of money doesn't mean you go out and start making bad deals. So I kept my underwriting guidelines the same, and I had to find a way to get this money out, or else they would move on down the road to someone else. So I started a hard money loan business, and he was a managing partner for Coopers and Lybrand, which is now Price Waterhouse Coopers.
Right. Those guys are our cousins now.
Yeah, and he was a managing partner for 15 years in Austin. So he's a perfect partner for the hard money loan business, and we've been in business since 2005. I think, it was a sideline gig for both of us. It was just kind of a sideline, but we have $8 million out locally to investors that I compete with every day. But they just found a deal before I did, and they need some money, and I got some money that I can loan them in short increments until I need it. So
well, listen, you might as well loan it to them, because if you don't loan it to them, somebody else will. So you might as well make the money. If you can't make the money on the deal, make the money on the money.
Right. So someone says, so why would you help your competitors? I said, hey, they're going to be there with or without me, so I might as well make some money off of them as they pass by.
That's right.
So let's just kick it off here. You're dealing in probably pretty big projects compared to little houses and one-off houses that we're doing in San Antonio. But talk to us a little bit about syndication or raising a private fund for yourself if you're really into this investor business and you really want to get some substantial funds, and which way's maybe the best way to go, or which one fits different situations?
Well, listen, first of all, in the money business, you got to have two kinds of money. There's equity and there's debt. And almost every deal requires some amount of equity. Unless you have a special situation, lenders are generally going to require some debt. They're going to require some equity component. So if you go to one of those hard money lenders, they're going to probably require that you have 30-40%, whatever their number is for equity before they'll put their money in, and whatever the arrangements are. You know how that works. But
part of finding money is having a great deal to begin with, and part of that being a great deal is having some equity, right?
Yeah, well, there's right. So there might be built-in equity, but somehow there's got to be some equity in the deal. And if there's not, if you don't bring the equity in the deal, then you got to bring the cash. And so the syndication of the fund business really is the way that you bring the cash to the table. Now, you can also have some debt. You can do all different kinds of things. But imagine the fund being your bank, and you walk into the transaction, you negotiate with the money ready to go in the bank account at that moment. So that's kind of the advantage of having your money organized. I mean, here's the bottom line. is that most people scramble around. They get private money, they get hard money, they organize whatever they can. And when you're early in your business, you're lucky to get any money. I mean, the truth is you're lucky to get anything. And so you're dealing with hard money lenders, which are really semi-professional or professional investors. I mean, you guys are professional investors. And when you're making loans, I mean, you guys are looking at properties probably more carefully than the guys that are buying them in many cases, because the likelihood is that you might own those properties. I mean, that's probably what's going to happen, 80% of the time of those hard money transactions. But, the big money isn't made that way. The big money is made the way Wall Street makes their money. And at some point in time, many guys wake up in the morning and they say, I'm working really hard. I'm getting really good at this business, but the lenders are making more money than I am. I got to find a way to bring my cost of capital down. I got to do it differently. And ultimately, the way that Wall Street does it is a better way. And that's because the cost of capital is cheaper. There's more control of the capital. It's better money. And it just provides you with enormously more flexibility and more capability in terms of how you negotiate and how you move your money around.
Okay, so I would like to talk about, the syndication doesn't interest me personally that much because I'm not doing apartment complexes or those big. I'd like to learn how, let's say I'd like to learn how to raise a fund. Where do we start?
Well, so first, let me tell you the difference between a syndication and a fund, just to be clear. Okay, just kind of a baseline. There's really not like a legal definition of this. I mean, so it's kind of a flexible thing. But here's how I think about this. A syndication is a project. So let's say you're going to buy a small apartment building, 10 units, whatever it is, and it's $300,000 or $500,000. And you say, we're going to fix it, and then we're going to sell it, and then we're going to give all the people their money back plus their profit. That's a syndication. It's a project.
Okay.
A fund, it's the same thing. You go and you buy the building, you fix the building. The difference is that when you sell it, you don't give the people their capital back. You only give them back their profit. You retain the principal, and you can go do more deals with it. So a fund is not a project. A fund is an ongoing business that's going to last for a long time. So people commit to put their money in for, let's say, 5 years. Even with a project, they're going to put their money in for 2 or 3 years or, whatever it is. But in a project-based environment, you're constantly raising money. In a fund environment, you raise your money in advance, and then you have the money ready to go. Now, a fund is a little harder to raise because people have to trust you more, because there's no project that's ready to go necessarily that they can actually see. And these are they're called blind pools sometimes, because people are putting their money in and they expect that they're going to that they're going to get a certain return on their money. Which they will, and there's a whole rhythm to how that works. And believe it or not, wealthier people really prefer this. Smaller investors want to see what they're doing. They want to look at the money. They want to, they want to check in it like a little baby. They want to check on it all the time. Wealthier people want to set it and forget it. They want to put it in a responsible, good place, and they just want to get their checks every 30, 60, 90 days and just know that the cash flow is going to be there, principal safe, growing at a good pace. That's it. So funds are really very sophisticated. And imagine the negotiating power that you have with a fund when you walk in, you say, listen, I got the money ready to go here today. What do you want to do? I mean, that gives you a lot of power.
Yeah, it certainly does. So when you're building a fund or a syndicate, you have to talk to accredited investors in both cases. And maybe you should start off by defining what an accredited investor is for the people.
So first of all, the rules are exactly the same for syndications and funds. So there's no difference. So it's basically two different golf clubs. They're tools. They're different tools inside the same golf bag. So the rules are the same for both of them. And you just decide which one you're going to do. Now, first, let me just tell you that you can have a fund with 20 investors and then 4 or 5 investors say, hey, Joel, Mitch, I'd like to, can we organize and buy that one building over there? Let's say the building isn't inside the charter of whatever the fund is. We've set up some set of guidelines. Let's say it's outside that. It's in a different geography. It's a different size, a different asset class, whatever. So we're going to go do something different. You can, a lot of guys will set up a fund, then they'll set up a syndication, then they'll do another fund and 2 more syndications. So a lot of guys end up doing all different things. Once you understand how the tool works, it works very well. And you can do all different kinds of things. So then the next question is accredited investors. That's what you're asking about. In 2013, the government changed the rules that had been in place for about 80 years about how this works. This business had always been a secret, which is kind of the reason it's a country club business. It had been a country club business where rich guys would put their money into these secret deals. And these are called private securities. So in other words, what you do, you set up an LLC and you sell shares of stock. What Wall Street does very, very well, better than anybody, is they take assets and they slice them up like a loaf of bread and they let people buy it. So a big building, the Empire State Building, for example, you slice it up into a lot of little pieces called shares of stock. And people say, okay, I'll take 1 share, I'll take 10 shares, I'll take 22 shares, 14 shares, whatever you want. Wall Street's great at that. And then everybody buys exactly what they want. They put it all together into a clump or a pool, and now everybody's happy. And then one guy's going to run that thing, and that guy's the syndicator, the promoter, the fund manager, all synonyms for the same thing. So under the old rules, you could have a handful of non-accrediteds, and an accredited investor is somebody who either makes $200,000 or $300,000, depending if they're married, or has a net worth of $1 million or more. So that's accredited. It's not the highest standard. I mean, that's it's only 3% of the population, but that's what it is. So
worth how much?
Worth either either has an income of $200,000 or $300,000, 200 single, 300,000 married, or $1 million net worth, not including their home.
Okay.
All right. So that's 3% of the population is allowed to do this. And then they had an exception for non-accrediteds under the old rules that you could have 35 people who are not accredited come into a single deal. Now, understand the government perceives these deals to be a little risky, and they're more risky than for example, the stock market, although maybe they're not. But the government doesn't examine these deals; they're exempt from registration. So the government's not examining all these different deals, and that's why they would prefer for us to deal with more well-heeled people. So the government really kind of prefers that we stay away from regular people and kind of lean toward these accredited investors. But there's an exception. You can have 35 people under the old rules. And the old rules, you can either choose the old rules or these new rules. And so under the old rules, you can have these non-accrediteds, 35 of them. So if you have cousins, relatives, neighbors, whatever it is, you can scoop those people into your deal and put them alongside of the wealthier people. There's no problem with that. I mean, you can do that.
So you're saying 35 people total, but or you're saying only 35 non-accredited investors and
35, up to 35 non-accredited. You could have 1,000 people in the deal. Well, not 1,000.
35 non-accredited.
Let's say you took 100 people in the deal. 35 of them could be non-accrediteds.
Okay.
But you want to deal with accrediteds mostly because that's where the money is. So there's more money with these accrediteds than with non-accredited. So, but you might, from time to time, do somebody a favor, let them come in your deal, or whatever the reason is. So under the new rules, you're allowed to advertise. Under the old rules, you couldn't advertise. You couldn't go send out bulk emails and do all kinds of things that people are doing now. So it depends if you want to advertise or not, whether or not you're going to take these non-accrediteds into your deal. And
you talk to us about the advertising.
Well, in the old days, this was a secret business, and it was kind of that's why I said it was a country club business, is because it would be guys at the country club would all do deals together. But now you can advertise as long as the person is accredited that comes into your deal. So only accredited investors can invest in these deals if you advertise.
So how explain to me this? If you know the person, you can already talk to them, right? Because you know them, right?
Yeah.
So how do you decide if they're accredited or not accredited if you don't know them? Where do you go to find accredited people?
We're going to get a little technical here, but under the old rules, they self-certify. They say, I'm accredited, yes or no, and you take their word for it. Under the new rules, they have to be verified. So either an accountant or an attorney or a stockbroker or a service, there's sometimes some of these third-party services will verify. And all that means is that they ping the IRS and they say, did this person do more than a couple $100,000? Yes or no. If it comes back yes, they're automatically verified. So
you can do that?
Well, you and I can't do that, but there are services that will do that. Yes.
Okay. So they'll say, you can say, I want to solicit to 10,000 people that make over have a net worth over $1 million, not including their home, or make over $300,000 just to cover all the bases. And so they go out and they'll give you a list of these people, or
Oh, no. The IRS is not going to give you a list of people.
no, the service will go out and figure out.
No, the services just verify that people are accredited. You have to go do your marketing yourself. So let's say you go buy a list of wealthy people, and and there may be accredited, non-accredited on the list. You don't know because they sneak in. You never know how it is. So you send out an email and you say, listen, we got a deal coming up. Who'd like to be involved in this deal? Let's just say you do that. And you don't, let me just first say, I'm not an attorney. You don't just randomly send out emails to people. You need to be supervised. This process is very complicated. You don't just, we're just talking kind of in generality here, you and me.
Okay, good.
But I just want people to know, don't take this as advice. This is not advice because
This is a 10,000 foot view from the top.
It's a 30,000 foot view.
That's 30,000 view.
Right. So if you want to do it, then you got to learn how to do it. And we do teach people a lot about how to do this. And we have attorneys that supervise, and it's a careful thing. So you go out and you find these people, and let's say that 10 people call you up and say, listen, I like this deal. I'd like to learn more about it. At that time, you don't know these people. So once they say that they want to come into your deal, then you have to verify them.
So they raise their hand and then you verify them.
Yeah, you verify them.
Listen to anybody, but as soon as they show up, we need to establish whether they're accredited.
What the government did, and this was really smart, is in the old days, you were not allowed to show your paperwork to non-accredited investors. But what the government realized, because of social media and everything, people are seeing everything nowadays. So what they realize now is it doesn't matter who sees your paperwork. What matters is who invests in your deal. So they said, okay, look, you can advertise, you can show anybody you want what you're doing, but the only people you're allowed to let into your deal are these accredited people. So they changed the rules for the much better. Now, let's say, for example, that you've got some non-accrediteds in your life, cousins, neighbors, relatives, whatever it is. You're allowed to use the old rules where you don't advertise and you bring those non-accrediteds in. So, just depending on your situation, there's a little strategy and you have to figure out which way you're going to go.
Very good. So, I've toyed with the idea of building a fund myself. Do I need someone to help me with this, or do I order the rules manual, or what? How? If I want to build a fund, what's my first?
That's a really good question. Here's the thing: a lot of people think that the documents are just a necessary evil, and I would tell you that this is the one time in your life that you get to write the rules exactly the way you want those rules to be. And if you get this wrong, you're going to be stuck with it for years. So I would also tell you, an attorney always writes this down. The attorneys, this is what they do. Certain securities attorneys, they write this down. But you never want to go to this attorney for business advice because they don't know. They don't know what the right rate of return is to pay the investors. They don't know what the right way to pay the syndicator the fees are. They don't necessarily know the best way to structure the transaction.
They know how to write documents.
They write documents. They don't make deals. And you want to be very careful not to confuse those two things. I know I'm very clear. I don't give legal advice, but they are not always clear that they don't give business advice.
very, very good point. Yeah, okay, so where are we headed with this? I'm asking, how do I start out? I want to build a fund. What do I do?
Well, listen, the first thing that I would tell you to do is you probably need to learn how this whole process works. I mean, you don't just jump into it and start doing it. You got to figure out, is this really for you? Is it something you can do? Is it something you want to do? And we offer a whole program that helps people. And this is not a beginner program. This is for somebody, if they're fixing and flipping, if they've done 10 or 20 deals, they're very experienced. I would tell you that those people would be ripe to get better money, because at some point they wake up in their money in the morning and they say, listen, I'm really good at this. I should be making more money. And these hard money lenders should be making less. And there's only a certain amount that they'll negotiate. And at some point you want to go out and get better money. And the kind of money we're talking about is better money, because it's pre-committed. It's always accessible. It's less expensive. It's better money for a lot of reasons. So I would tell you that you need to kind of learn how this works. And then if it works for you, then you need to move along. And the beautiful thing about this is that the fund pays for all of its own legal expenses. So it pays for its development. Of course, the fund doesn't exist at this moment, so you have to advance some money to get it going. But once it's going, it'll reimburse you for whatever it costs you to put it together.
keep good records, keep track of what you're spending. So
Yeah.
where do I go, Joel? Where do I go? Do I go to you?
You come to me. That's what we probably have the most substantial company in the country that teaches people how to do syndications and funds. I mean, we've launched, our program has probably spawned 75 funds and 150 or more syndications. So we have put a lot of guys in this business, a lot of guys that are making an awful lot of dough. I mean, it's an awesome business that.
But this is not a course. You're not selling a course. You're just trying to show people how to do it because that's what you do, is help people.
Well, that's my business. I mean, this is what, I've been in this business for 35 years. 10 years ago, an executive from Marks and Millichap, the largest commercial real estate brokerage in the country, called and asked me to come out and help them to do this. And it turned into this program because it was so incredibly well received. So people they want to understand it. They want to learn how this works. And so we set up a program that would help them to learn. And step one is you got to learn how this works. I mean, you got to take a little course in how it works. And it's not an online course. I mean, you come physically and you're sitting with other people, 20, there's 30, 40, 50 people in a room, and we learn how this works. And it's, how do you pay the investors? How do you, the promoter, get paid? And let me just tell you, this is a beautiful business because you get paid in many, many different ways, but effectively there's two big ways. One, you get paid for being smart. And all those wholesalers and all these guys, they all get paid for being smart. I found a deal, it went up in price, bang, I made a percentage. You share the money with your hard money lender. That's being smart. But what's not smart is that you've spent 6 months waiting for this money to come in. You've gone out on credit cards, and by the time you get your profit, you have enough to pay down your credit cards, and now you're back in the same place where you were. So the way the syndication, the Wall Street method, is that you get paid for your time. So because it's an LLC, it's going to require a real estate broker. If you're properly licensed in your state, you can be the broker of record. You can broker every deal. You can be the property manager, the mortgage broker, the property manager. You can be the construction manager, the general contractor. I mean, all the services that this thing requires, you can render those services if you're properly licensed and you're properly equipped to do that sort of thing. And the investors are okay with that because they know you're not taking a salary, and this is not a salary, it's not a job, it's an opportunity for you. So you're being paid along the way, you're building out your team, you're running your affairs. And by the way, unlike hard money lenders, these investors are not hoping that you go broke so they can steal the property from you. These people need you to run that deal. They want you to get into the long term because you're the manager of the money. I mean, these people take you into their family. I mean, you're running their money. I mean, you're really providing them with an important resource here. So, listen, this is a really important, it's an important job. It's a responsible job. It's an incredible business. And there's more money in this thing than you could possibly imagine.
So what's the name of your company?
Our company's Bullseye Capital.
Bullseye Capital.
Yeah.
So you can go to bullseyecap.com. Bullseye.
Yeah, but that's not where the symposium is. I mean, I think you guys.
I understand. I just was trying to give them a little heads up.
Yeah.
We're going to have a link here for the Investor Summit. Go to reinvestorsummit.com/raise capital. And I just made that up on the spot. So that's what we got, raise capital. And that'll send them over to the show notes, Joel, where we can post anything we want. We can post the times and the links to the symposium. The symposium's the 23rd of November, right?
No, actually, it's the this upcoming one is the 27th of October.
27th of October. We're in 2019 right now, but since these podcasts will be archived maybe for a long time, so
October 27 to October 30th, it'll be in Las Vegas, and we do this typically every 6 months or so.
Okay. That's great. Get in there in the room. It's probably a pretty interesting room too, right? Because
it's a very sophisticated audience. People have to qualify in. I mean, either they're real estate professionals licensed in some state, or they're financial or intermediary type people, CPA, attorneys, bankers, lenders, those kind of people, or they have asset class specialization. So they fix and flip, 5 or 10 or 20 houses. And here's the deal. If you can't demonstrate that you know what you're doing, you're not going to raise any money. I mean, you have to practice on your own. These investors do not want you practicing with their money. you know, and what I tell people is there's a reason that doctors practice on cadavers. You know, these are very low value targets, you know. So,
Hey, so if I came and I said, you know, I've done 2,000 houses in my town. I bought 100 houses a year for 22 years. This is my model. I buy houses with other, you know, borrowed money, and I sell them, and I carry the note and create 30-year mortgages. Would I stand a decent chance?
you know, I'd have to take a look at what you're doing. You know, here's why: because the syndication, the fund business doesn't really have a cost of capital. It's highly leveraged, and there's really not a cost of capital. Now you do have a preferred return, but that preferred return ends up being more of an advance to the investors. So the cost of capital is really zero. You've got a cost of capital. The other thing is that the syndicator is taking different kinds of fees for things that they're doing. So when you factor all those things in, plus the ready access to the capital, my guess is, and you could still refinance and do all the things that you're doing, you know, and retain equity. My guess is you probably see that it was probably advantageous.
Okay, but yeah, the devil's in the details, right? So you have to figure out if it's the right fit for your business and your.
I mean, listen, you have a very sophisticated operation. You guys are doing a lot of what you're doing. I will tell you that most of the time, guys that are running hard money, the best way to do it is in a fund environment.
Yeah, yeah.
I mean, here's the thing: the biggest restriction of all in a private money environment is it's one investor, one house.
Yes.
This is, you know, if you start buying anything that's a little bit bigger and you want to put 2, 3, 4 people, it gets very, very clumsy to put individual people, all of them on a mortgage note, secure them. This is all unsecured. And by the way, if something goes wrong on one of your deals, they have the right to foreclose. In this, it's unsecured. There's no security. So that's why the Securities and Exchange Commission likes to oversee this. The government oversees because it's unsecured. And that's why they perceive it to be a little more dangerous. But that's really the name of the game here, is that investors are putting their capital into a pool which is unsecured, and then they have a percentage of all the activity. But I will tell you what's better for the investors, and that is that there's a little bit of insurance here. If they buy one house and that one house gets hit by a meteor and it's destroyed and there's no insurance, they're out of luck. You know, but in a fund, it might just be 1 out of 100 assets that they're partners in. So in a certain way, wealthier people prefer to be part of a distributed pool because there's a certain amount of diversification, the protection. Yeah. So there's, you know, what I would tell you is that you have an enormous advantage because you probably got a great network. I mean, you probably have just a tremendous following, and but we'd have to take a look at your numbers and see.
Well, by now, 22 years later, you know, my people have been loaning me money for decades, or, you know, a decade and a half, at least a decade. They don't keep loaning me money because I don't pay them back, you know, or because things are going crappy. They're the same people, but it took 22 years to get here. And I think your way might be faster. If I was starting over again, I might do it different.
Yeah, I can tell you it would certainly be faster. It's much more. It's more economical. It's less transactional. There's a lot less friction in the transaction. Let me put it like this: Wall Street wouldn't do it this way if it wasn't better. I mean, Wall Street's not calling us for advice about how to do deals, right?
No, they're not. But they're also doing massive.
But you know what? This starts at $500,000. This doesn't start at 20 billion zillion dollars. I mean, this starts small. I mean, the guys that we deal with are generally dealing with $500,000 to 10 million. I mean, that's kind of the range of guys that we have. There's a handful of guys that have gone way outside that range that are pushing 100 million, and they're doing awesome. But most of the guys are working in a much smaller level. You know,
maybe I'll come see you October 27th in Las Vegas. Maybe I'll come see you because I've been contemplating it. I'm just like, but I would bring my partner who was with Coopers and Lybrand. He would be more the guy to handle it than me. I'm kind of the guy that goes out in the streets and creates all the product for the fund to buy.
Listen, we've had a lot of CPAs. You know, I'm a CPA. I don't practice, but I'm still licensed, and we've had a lot of CPAs that have come through. So, and they find it fascinating. And just because you're an accountant doesn't mean you know anything about the hedge fund business. I mean, it's a totally different business. And setting the thing up the right way and making money and getting your formulas just right, it's an art form. But it's the one opportunity in your life to lay this thing out the way you want, exactly how you want your business to run.
All right. Well, my people are going to get together with Joel's people, and they're going to get over to the show notes, and they put all the links to anything, the phone numbers, the links to the symposium, whatever he wants to put over there. Go to reinvestorsummit.com/raise capital, and you'll get over there and have a chance to delve into this a little deeper. And I'd really like to thank you for taking the time to be on with us, Joel.
Hey, well, listen, thanks for doing it. Maybe we'll continue the conversation.
Sure. I want to go back, and I just have been talking to some venture capitalists. That money seems really expensive to me, but it seemed like they could raise it pretty fast, and like you said, not a lot of strings attached. So I'm in the middle of this conversation myself. I like to go back and maybe develop some real life questions that I'm going through right now, and maybe I'll just ask them to you. See, that's one way to get all your questions answered. You just tell them you want to interview, and then you ask them all your questions.
Well, listen, that's what makes for a great interview, is whatever questions you have, the audience probably has too. So, and then you have the ability to attract experts onto your show, which is a lot of fun.
Well, this is the Real Estate Investor Summit podcast. I'd like to thank Joel Block for taking the time to talk to us a little bit about syndication and fundraising. But man, the topic is huge. You can talk about it probably, well, you're going to be talking about it for 3 days on October 27th through the 30th up in Vegas. But thanks for stopping by to get you some Joel Block. This is Mitch Stephen with the Real Estate Investor Summit podcast. And until we meet again, I'll see you then. Bye, Joel.